Welcome to Chapter 5 on diversification in our course on an introduction to quantitative trading. So far we've considered a simple momentum strategy for a single asset, namely gold futures is what we generally looked at. So we built this momentum signal and we applied volatility scaling to generate a position size. So we can backtest that strategy, compute its Sharpe ratio and its turnover, and evaluate its success. But this is all focused on a single instrument, and generally hedge funds will trade hundreds or thousands of different assets. One reason for this is that it allows the fund to allocate more capital without suffering as much market impact. So if they can spread the money across many different assets, they can trade much more efficiently in those assets by making small trades in a large number of assets. So that's one reason why to trade to diversify your portfolio. But the thing we're interested in this chapter is a thing called the diversification effect. And this really relates to the Sharpe ratio. So to demonstrate this, we'll just start with a simple case where rather than one asset, which is what we've looked at so far, we have two assets, A and B, traded using strategies S of A and S of B. So S of A tells us the position size that we want to take in asset A, and S of B tells us the position size we want to take in asset B and the associated returns. So we'll consider these as the return series. So for simplicity, let's assume that the daily expected returns of the two strategies are equal, so equal to some value mu. So the expected daily return is just some fixed amount, and the expected standard deviation in that amount is also fixed at sigma. So these are two kind of identical trading strategies. So the Sharpe ratio of either of the strategies equals the square root of 252 times mu over sigma. So both of these strategies have the same returns, the same risk, and the same Sharpe ratios consequently. So it seems like the Sharpe ratio is independent of the strategy in some sense. But there's this really wonderful thing that happens if we average the two strategies. So we take the wisdom from one strategy and the wisdom from another strategy and we combine them into the average. So then the Sharpe ratio of strategy A plus the strategy B divided by 2 equals the original Sharpe ratio, square root of 252 times mu over sigma. But now there's some term which modifies this, and you see on the top line there's a square root of 2, and in the bottom line there's this 1 plus the correlation of strategy A with strategy B. And the great thing is that if these two strategies are uncorrelated, so the correlation of strategy A with strategy B is equal to 0, then the bottom line becomes 1 down here, and the top line becomes the square root of 2. And this Sharpe ratio gets a boost by a factor of the square root of 2. So almost a 40% increase in the Sharpe ratio just for diversifying across two similar strategies. So that's what happens when these strategies are orthogonal and we diversify against them. So that's why back in chapter 3, when we looked at a momentum signal that was the average of a number of signals, we said there should be some boost in the performance, some diversification effect. And that's exactly what we're seeing here in this multi-asset case. We're averaging the returns from two different strategies, and we're getting a big boost given the strategies are uncorrelated. So the Sharpe ratio of the average diversified strategy is larger by a factor of square root of 2, and this is a massive boost in performance. Even more is possible as we increase the number of assets in the portfolio. And the overarching idea here is that a well-diversified portfolio will carry less risk with a similar return. So the returns will average out the same on the top line, but the standard deviation of the risk goes down as we share our risk among many different uncorrelated assets. The probability of everything moving negatively at once is much reduced if things are uncorrelated. So what I'm going to do now is take two different future strategies, two different momentum trading strategies. So I've got one strategy which is long gold and one strategy which is long copper with the volatility scaling. And what you see is that from 2003 to 2004, the strategy was the gold had a Sharpe ratio of about 1.3. Copper had a Sharpe ratio of 2.1, and the diversified strategy together had a strategy of almost 4. So if we look here at the returns, we see that the gold strategy performing down here in the bottom in the blue, the copper up in the top in orange, and in between is the diversified strategy, which averages the gold and the copper. The reason this strategy is better is because the Sharpe ratio is greater. So even though the strategy doesn't return as much, it does so with a much lower, it makes a lower return than the copper, but it does so with a much lower risk. So this Sharpe ratio is maximized for the green strategy. So that's a practical example of where averaging two strategies bumps the Sharpe ratio significantly. So here we're getting about an extra 10% on our Sharpe ratio. It's up to almost 2.4, which is pretty impressive for this strategy. Okay. Thanks for listening. This is an example. There's a lot of correlation between gold and copper prices, but we still see a 10% bump in the Sharpe ratio for the diversified strategy holding gold and copper futures. Okay, thanks for listening.